Howdy, everybody. This is Eric with Peak Financial Planning. Today, I'm going to answer two questions. One is, when it comes to investments, is it better to participate fully on the upside, meaning get the same rate of return as the market, or is it better to limit the damage that is caused when you have downside or negative rates of return on the market? Which is more powerful, and at what phase of life should you be considering that? The second question is, how do I actually use that information to help me make a decision about whether I should work with an investment advisor or which investment advisor should I actually work with? Okay, and these are really important considerations. This video is geared towards people navigating what I call the retirement risk zone, which is the 10 years prior to your desired date of retirement or the first 5 years in retirement. The 10 years leading up to your desired date of retirement are the period of time at which most people usually have the greatest portfolio value, or proportional to the rest of their life, they are the quote unquote wealthiest they've been because they've been savers and their incomes have improved over their lifespan. And that means that those portfolios are more sensitive towards negative rates of return in the market. And so that's why this topic is actually really important. The other part is, most people are going to make a decision about an investment advisor as they get closer to retirement, because when they're working or they have an employer sponsored or a workplace retirement plan, that decision just isn't really that relevant. So let's assume you're in that phase, navigating the retirement risk zone, and you start to consider, what do I do? How do I understand if I have enough money to retire, when I should retire, how much income I can draw from those assets in retirement? That's about the point at which you start talking to an investment advisor to help answer those questions. Now, I have other videos on my channel that you can watch to learn what are the financial planning considerations that help you answer the three big retirement questions of: when can I retire? How much money will my money last the entirety of my rest of life? And how much money can I draw each year from my portfolio when I do retire? That's a separate video. I'll put the link to that in my description here, but I have a lot of videos that talk more about the financial planning aspects. But let's assume you've already got some of that information and you're ready to start considering the investment considerations. Well, this video is going to talk about why I believe that when you are in that phase of life, the most important thing or investment philosophy you can seek out from an investment professional is a risk management philosophy that is more about capital preservation or protecting your investable money rather than seeking out big, great rates of return when you're that close to retirement. So let's look at a few scenarios here. I'm going to show you three different scenarios. I'm going to start by showing you what happens if you were to just invest with the market, right? This kind of floats around in the internet. Just put money into an index fund or an exchange traded fund that tracks the S&P 500. Set it, forget it. You'll be fine. Don't pay that much attention. And if you did that, I just took 5 random years of rates of return from the S&P 500. They are sequential and they do match the exact rates of returns from a 5-year period of the S&P 500. This is from the 1970s. And I said, if you have a $500,000 starting portfolio value, you were to invest in the index or exchange traded funds and seek dollar for dollar the exact rate of return that the market gives you, what would your result be? And the answer is, if you had these 5 years of rates of return, you had 2 positive years followed by 2 negative years followed by 1 huge positive year, you would actually start out with 500K and end with less than 500K. Even though your average rate of return over the 5 years was 2.18%, so it was a positive average rate of return, you ended up with a negative real rate of return because of what's called sequence of returns, and also because of the proportional effects of big negative rates of return. When you have a big negative rate of return, you need a proportionally larger positive rate of return to make up for that negative. What does that mean exactly? To take away the big words, if you have a 30% decrease in portfolio value, you actually need something like a 45% positive rate of return just to get back to break even. And you can see that illustrated here. Our portfolio in year 3 ended at 530,000. You have this negative 30% rate of return in year 4. That brings us down to a portfolio value of 371,000. Then you have this huge 32% almost, or 31.55% rate of return in year 5. But that's still, even though it's bigger than your negative 29% the year before, you still end up almost $40,000 sorry, yeah, my math is right there. $40,000 from being at break even because of the proportional nature, the exponential nature of negative rates of return that require much larger positive rates of return to make that up. So if you just looked at this, you'd understand that part of the name of the game here is downside risk management. We just can't participate in these huge negative years. We cannot allow the portfolio to just go down and hope that we can make it up. This is what you call a 5-year trip to nowhere. You took 5 years, you started with 500K, you end the 5 years without even taking withdrawals, and you have less than 500K, even though you had positive rates of return. So that's just not going to cut it, right? So I expanded my screen here, but let's go look at what happens if you actually have um, an advisor, and the goal of hiring the advisor is to help you make better decisions, limit the downside, and either protect your money or make more money. Now, my case is you're rarely going to find an advisor, or never going to find an advisor who's going to make you more money by beating the market. They're not going to beat the market on your behalf. Statistically, that hasn't been borne out. There's very little proof that that's possible. But what if the focus was on what I call risk management, or the industry calls risk management, and capital preservation? So look at this advisor B here. This scenario, you start with the same amount of money. But what this advisor does for you is they risk manage your portfolio so that instead of getting 100% of the market rate of return on the upside, you actually only get 90%. So you have a slightly lower rate of return, 10% each year on the positive years. But what they do is they're nimble and adaptable, and they actively manage your portfolio so that on the downside years, you're only participating in 80% of the downside. So you're getting 20% less in losses. You're having a 20% risk reduction through the use of an advisor. And you see, instead of a 17 and change negative year in year 3, you actually have a 13 and change. They're almost 14%. So they do protect you by about 3% on the losses. What is the actual net result? Well, you have an average rate of return that's 2.9 instead of 2.18. But more importantly, you have a positive real rate of return. You still kind of had a 5-year trip to nowhere, but instead of being down $11,000 from your starting value, you're up around $30,000 or $27,000 here. So you actually went somewhere. And what they did is they helped you basically uh, make the delta, the difference between. So the difference between this of around 40,000 is what that advisor's advice was worth, right? And more importantly, what they did is they saved you time, because now you don't have to make up this $40,000 difference. Now, let's use a third scenario and say, well, what if we trade off even more upside? What if we participate in less of the market upside, but that allows us to participate in even less of the market downside? What does that do? Well, in scenario 3 here, let's say the advisor participates in 80% of the upside instead of 90, which is this blue, and instead of 100. So they participate in 80. So they're getting you 20% less on the upside. But in return for that, they can help you participate in only 60% of the downside. So they're giving you 40% risk reduction instead of 20 as in this blue scenario. Now you can see on the right here, a negative year on the market of 17%. The advisor can help you have only a 10% negative year. So they're saving you 7% of downside on this year, and even more on the year 4. Well, now you have an average rate of return that's 3.6%. So it's almost 1.5% higher than the market over that same period. But even more importantly, you have a significantly greater positive real rate of return over the 5 years on your ending portfolio value. And that is just the most important thing to take away from this is if you're close to retirement and and the market has bad years, you just don't have the time to make up those losses. So it behooves you, in my opinion, to have less participation on the upside. And yes, that's always hard to swallow, but the trade-off should be that in doing that, in having less participation of the upside, you also have less participation to the downside, which means you get a better overall average rate of return, a more consistent, steady one, even though it's more modest. And you end up with a more predictable and stable retirement planning and retirement outcomes, because now you can make better decisions. You're not swinging wildly. When you combine this type of investment framework with a good financial planning framework, where you're actually doing the financial planning decisions like tracking expenses, setting an annual spending budget, doing Roth conversions, doing good asset location strategies. And there's a whole slew of these that I have in another video that you can watch. I referred to it at the beginning. That video refers to the financial planning considerations that should be done in tandem with this type of an investment philosophy. And again, specifically for individuals in the retirement risk zone or in that 10-year period for retirement and the first 5 years of retirement. When done in tandem, you have a much more predictable, stable retirement strategy that will give you peace of mind, allow you to make better decisions, allow you to have more comfort, less anxiety in the pit of your stomach, and again, really solves the problem of you can't waste time and make up that time when you're that close to retirement. So to summarize here, I'll get us away from the all the different numbers there. I recommend thinking of things through this lens when you're getting this close to retirement and you're starting to want to answer those questions of when can I retire, how much money can I draw in retirement, what will my assets last until end of life, and then what investment decisions do I make to be consistent with that. You really have to think of them as two components to the same strategy. They have to be done together. The financial planning considerations should be done first, and then the investment philosophy should lag or follow those financial planning considerations, especially when you're in that retirement risk zone. So hopefully this was helpful and it gives you a lens through which to evaluate um, what type of investment philosophy or strategy is right for me. Again, remember, this video is only geared towards people in that specific area. You're going to have different investment philosophies at different phases of life. But if you're in this phase and you'd like to, you're starting to consider these things, I hope this was a helpful guide. And if you'd like to talk more about it, you're more than welcome to reach out to me. You can find my contact info on my website at thepeakfp.com. I'll include links below. You can also find a link to schedule a free consultation, and we can talk about financial planning strategy, the investment philosophy, what might be a good fit for you. But really, more critically, start to talk about how do you address those key emotional questions of when can I retire? When is it responsible and appropriate? How much money can I draw in retirement? And how do I make my money last so that my money outlives me rather than me outliving my money, so that you can have a stable, comfortable retirement and kind of not feel guilty and anxious the entire time. So hopefully that was helpful. Again, links will be in the description below. Feel free to put any questions or comments down below, and I'm happy to answer them or make a separate video specifically on those topics. Again, this was Eric with Peak Financial Planning, and thank you for your time and attention. Hope to see you soon.